Hello everyone, welcome to today's US Open live webinar. It is Thursday, June 29th, 10 minutes before Wall Street opens. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. We have quite a lot of things to talk about today, starting with hawkish commentary from Chair Powell at ECB's forum in Sintra, and less than an hour ago, we also got strong final Q1 GDP from the United States. We also have some tech jitters after reports for a new AI chip ban from US to China. And we're also going to talk about the Aussie after yesterday's inflation deceleration, and we have to talk about big data points coming up tomorrow. Before we begin, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We have your USD on our screen. Let's start with that. The pair dropped yesterday after hawkish Powell remarks at the ECB forum in Sintra, as I already said. In particular, he expressed the belief that there is more restriction coming due to high inflation and very strong labor market. And he did not take off the table moving at consecutive meetings, back-to-back rate hikes, essentially embracing the 50 BPS outlook from the Fed projections. Now, the pair initially found support today, but now turns again negative after the strong US GDP data that came in a little earlier. Final Q1 growth was 2%, a lot higher than the preliminary figure of 1.3%, but still a little bit lower than the 2.6% Q4 final. Now, that of course means that with continuing strength in the US economy, the Fed is more free, let's say, to pursue an aggressive, sustained restrictive stance. As such, the pair is pressured, and that creates risk for further weakness. But the downside appears well protected, and we struggle to see the 2023 lows at 1.0634 getting challenged. Despite the renewed headwinds, the pair had defended yesterday and earlier today the EMA, the 200-period EMA, and as long as it stays above that, immediate bias is on the upside, and that gives it the ability to extend its advance. But we're cautious for new 2023 highs at 110.96. It doesn't look like the common currency has the momentum to go anywhere fast at this stage. Now let's move to the Australian dollar versus the US dollar, which slumped after yesterday's data showed that monthly inflation decelerated sharply to 5.6% year over year in May, and the lowest in 13 months. The Reserve Bank of Australia had restarted its tightening cycle recently after a short-lived pause, and this print may give policymakers more breathing room ahead of Tuesday's meeting. We'll talk more about that towards the end of our session on the what's ahead part. Now, the pair is exposed to 0.6563, but the 2023 low at 0.6456 still looks a bit distant. Already, the Aussie has managed to stabilize after Wednesday's slump, and this may give it the chance to bounce, but it will need a strong catalyst to reclaim the 200-period EMA at 0.67, and definitely does not seem to have it doesn't convince us that they can do that at this stage, given the prospects for another hike by the Fed, or at least another hike. In any case, if it manages to close above the EMA 200, as we said, that could pose a downside momentum, but more strength is difficult. And we're still 4 minutes before the US session kicks in, but let's go ahead and check the Nasdaq, the Nas 100, which had some adverse news to contemplate. Hawkish Powell, for one thing that we talked about, and the Q1 GDP, the strong Q1 GDP, is not necessarily good, since, as we said, it enables the Fed to hike more aggressively. More than that, there was a Wall Street Journal report which indicated that the United States are looking to impose an export ban to China of artificial intelligence chips. This threatens to undermine the main driver of this year's bull run, the AI boom. Nvidia, who has enabled it and reaps the benefits already, along with other chip makers such as AMD, were pressured yesterday. Micron, on the other hand, reported strong quarterly results driven by AI, and that helped the tech sector. Now, the headwinds, which are aggravated by at this stage by the Q1 GDP figures, may cause a further pullback, but a strong catalyst would be needed for a breach of the 200-period EMA at nearly 13,500. However, the index shows resilience and bulls are in control, poised to set new 2023 highs at 15,301. And of course, the road to record highs remains open. The black line up here, 16,771, but this may prove elusive in the near to mid term. So now let's round things off with what's ahead. We already talked about growth from the US. Tomorrow we expect figures from the UK. The UK economy has performed less bad than expected, and the Bank of England does not expect a recession any longer, following a stark revision of its previous projections. Preliminary Q1 was plus 0.1% Q-on-Q, same as Q4 final. Risks though may mount as the BOE continues tightening, creates fears for a borrowing crisis. Also on Friday, probably the biggest event of Friday is US May PCE inflation update. The April figures had shown an uptick on both core and headline, but the most recent CPI report for May showed a moderation in both. In any case, inflation is far from the central bank's target, and the core is particularly sleepy. And of course, along with strong labor market and strong economy, this raises chances for more hikes by the Fed. We also expect the Eurozone June preliminary CPI inflation. It had decelerated sharply in May, headline was 6.1% and core 5.3%. However, the ECB is not satisfied with the outlook, which is projected to remain high for too long and has pointed to more rate hikes, at least for July, and then they will see what they're going to do next from autumn. Also in the spotlight tomorrow, China manufacturing PMI for June. One of the data points that have disappointed markets over the last couple of months have created concern around China's recovery. After its expansion at the start of the year, it has returned to factory activity, has returned to contraction territory, since April. Now, before our next session on Tuesday, the Reserve Bank of Australia announces its latest monetary policy decision on that day, on Tuesday. Inflation has peaked but remains high, so the bank has raised rates for 2 straight meetings after its recent pause, as I already talked about earlier. And we also talked about the latest monthly CPI, which showed significant easing, and this may give officials a chance to pause again. We'll see how this will play out. Also looking ahead, US markets Wall Street will be closed on Tuesday due to the Independence Day, and will close early on Monday as well. So that's also something to have in mind. That's it for me for today. Thank you for joining me. We'll talk again on Tuesday at the usual spot, 10 minutes before Wall Street opens. It will be closed on the day, but still we will host our session. Thank you.